All right, lock in for the next few minutes because what I'm about to walk you through is not speculation, it's not fear-mongering, and it's certainly not another retirement planning tip you can ignore. This is about a regulatory framework that has been quietly moving through the Treasury Department, the Department of Labor, and the Internal Revenue Service since 2024, and it fundamentally changes how and when you can access your retirement savings. I'm talking about proposed modifications to required minimum distribution rules, new withdrawal sequencing mandates for qualified accounts, and a policy shift that treats your IRA and 401k not as your money that you've saved, but as deferred tax revenue that the government has a senior claim on. If you're over 50, if you have significant assets in tax-deferred retirement accounts, or if you're planning to retire in the next 10 years, you need to understand what's happening right now. Because the window to reposition is closing faster than most financial advisors are willing to admit. The framework being discussed in Treasury technical guidance documents released in late 2024 introduces what they're calling systematic withdrawal optimization. The language is deliberately opaque, but the mechanism is simple. Under current law, you must begin taking required minimum distributions from traditional IRAs and 401ks at age 73, and those distributions are taxed as ordinary income. The proposed changes would add restrictions on how much you can withdraw above the RMD threshold in any given year, particularly if your account balance exceeds certain levels. The stated justification is to prevent wealthy retirees from depleting tax-deferred accounts too quickly and shifting the tax burden. But the practical effect is that your access to your own retirement savings becomes conditional, subject to annual limits, subject to IRS approval, and potentially subject to penalty taxes if you need to access more than the government deems appropriate. This isn't coming. The regulatory comment period closed in December 2024, and implementation is projected for tax year 2027. That gives you less than 2 years to understand the rules and reposition if necessary. In this video, I'm going to walk you through the exact regulatory history that led to this moment, the 3 specific mechanisms that will restrict your withdrawals, the historical precedents that show governments always move to control retirement assets during fiscal stress, and most importantly, the repositioning strategies you need to evaluate right now. This is not about panic. This is about process, timelines, and understanding what's actually in the Federal Register versus what's being reported in the financial media. So stay with me, because by the end of this breakdown, you're going to have clarity that most people won't get until they're sitting in their advisor's office being told it's too late to act. Before we get into the current regulatory proposals, you need to understand the foundational framework that governs all retirement policy in the United States. Your IRA, your 401k, your 403b, these are not actually your accounts in the way a taxable brokerage account is. They are tax-deferred vehicles created by the Internal Revenue Code, and the government retains significant control over the terms. When you contribute to a traditional IRA or 401k, you get a tax deduction today, but that money has not been taxed yet. The IRS considers it deferred tax revenue. You're essentially borrowing a tax break now with the promise that you'll pay it back later when you take distributions in retirement. This distinction matters because it means Congress and the IRS have broad authority to change the rules around when, how, and how much you can withdraw without it being considered a constitutional violation of property rights. You don't own that money in the same way you own money in a savings account. You own a conditional claim on it, and the conditions are set by tax law, which can and does change. The concept that frames everything we're about to discuss is called fiscal sustainability and intergenerational tax equity. This is the language being used in policy papers from the Congressional Budget Office and the Treasury Department. The argument goes like this. The United States has an aging population, rising entitlement costs, and a structural fiscal deficit that cannot be closed through spending cuts alone. Social Security and Medicare are projected to face funding shortfalls within the next decade. The federal debt to GDP ratio is approaching levels not seen since World War II. And the easiest source of revenue that doesn't require new legislation is simply to accelerate or maximize the tax collection on the trillions of dollars sitting in tax-deferred retirement accounts. As of 2024, Americans held approximately $37 trillion in IRAs, 401ks, and other defined contribution plans. The vast majority of that is in traditional pre-tax accounts, not Roth. Every dollar in those accounts represents future tax revenue, and the government has a strong incentive to collect that revenue sooner rather than later, especially if they believe account holders might find ways to minimize taxes through strategies like Roth conversions, charitable distributions, or estate planning. The thesis of this analysis is straightforward. We are entering a period where retirement account policy will shift from encouraging savings to optimizing tax collection, and the mechanism will be restrictions on withdrawal flexibility, higher penalties for non-compliant distributions, and new limits on how much you can take out annually even from your own accounts. This is not unprecedented. It follows the same pattern we've seen with required minimum distributions, with the elimination of stretch IRAs in the Secure Act, and with increased scrutiny on inherited retirement accounts. The trend is clear, and the next phase is already in motion. To understand why this is happening now, we need to look at the policy evolution over the last 50 years, because every major change to retirement account rules has come during periods of fiscal pressure. The Employee Retirement Income Security Act, ERISA, was passed in 1974, and it created the regulatory framework for private sector retirement plans. This was the foundation for 401k plans, which didn't exist until the Revenue Act of 1978 added Section 401k to the tax code. Initially, 401k plans were intended as supplemental savings vehicles, not primary retirement accounts. But over the next 2 decades, they largely replaced traditional pensions as companies shifted away from defined benefit plans that guaranteed lifetime income to defined contribution plans, where the individual bears all the investment and longevity risk. By the 1990s, trillions of dollars were accumulating in these accounts, and the government began to recognize both the political value of promoting retirement savings and the fiscal value of the deferred tax revenue. In 2001, the Economic Growth and Tax Relief Reconciliation Act raised contribution limits significantly, encouraging even more money to flow into tax-deferred accounts. But here's the critical shift. In 2006, the Pension Protection Act introduced automatic enrollment and automatic escalation provisions, which dramatically increased participation rates and account balances. This was sold as helping workers save more, but it also locked more assets into the tax-deferred system where the government retains control over withdrawal rules. Then came the Secure Act in 2019, which made 2 major changes. First, it raised the required minimum distribution age from 70.5 to 72, later adjusted to 73 under Secure 2.0 in 2022. On the surface, this looks like a benefit, giving retirees more time before forced withdrawals. But the second change was far more significant. The Secure Act eliminated the stretch IRA for most non-spouse beneficiaries, requiring inherited IRA accounts to be fully distributed within 10 years instead of over the beneficiary's lifetime. This accelerated tax collection on inherited accounts and set a precedent for restricting distribution flexibility in the name of fiscal responsibility. Now we're seeing the next iteration. Treasury guidance published in November 2024 introduced the concept of annual withdrawal caps for high-balance retirement accounts. The threshold being discussed is accounts with balances exceeding $2 million. For these accounts, the proposal would limit discretionary withdrawals, meaning withdrawals above the required minimum distribution, to no more than 5% of the account balance per year. The penalty for exceeding this limit would be a 25% excise tax on the excess amount, in addition to ordinary income tax. The stated policy goal is to prevent wealthy individuals from draining tax-deferred accounts early and shifting their assets into tax-free vehicles or offshore structures. But the practical effect is that if you have a $3 million IRA and you need to withdraw $200,000 in a given year for a major expense, you could face significant penalties, even though it's your money and you're paying ordinary income tax on the distribution. The regulatory timeline is critical here. The proposed rule was published in the Federal Register on November 15, 2024. The public comment period ran through December 31, 2024. Treasury is currently reviewing comments, and the final rule is expected to be published by mid-2026 with an effective date of January 1, 2027. This means anyone with a high-balance retirement account has less than 2 years to evaluate their options before the restrictions take effect. And here's the mechanism that makes this particularly restrictive. The 5% cap applies to the total account balance, not just the portion above $2 million. So if you have a $2.5 million IRA, your required minimum distribution at age 73 might be around $95,000 based on IRS life expectancy tables. Under current rules, you could take out more if you needed it. Under the proposed rules, you would be capped at $125,000 total, which is 5% of $2.5 million. If you took out $200,000, the excess $75,000 would be subject to the 25% penalty, costing you an additional $18,750, plus the income tax on the full distribution. This is a significant restriction on liquidity, and it disproportionately affects people who saved aggressively and accumulated large balances precisely because they were told these accounts were the best way to prepare for retirement. Now let's connect this to historical precedent, because restrictions on retirement savings withdrawals are not new, and every time they've been implemented, it's been during periods of fiscal stress. The most direct parallel is what happened in Poland in 2014 and in Argentina multiple times over the last 30 years. In Poland, the government, facing a debt crisis and pressure from the European Union to reduce its deficit, nationalized roughly half of the assets in private pension funds. Account holders were told this was necessary to stabilize the system, and their private account balances were converted into promises of future government pension payments. The mechanism was different from what's being proposed in the United States, but the principle is the same. When governments face fiscal pressure, retirement savings become a target because they represent large pools of accessible capital. In Argentina, the government nationalized private pension accounts entirely in 2008, folding them into the state-run system. Account holders lost control of their savings, and the government used the funds to finance current spending. Again, the justification was fiscal stability and protecting retirees from market volatility, but the result was a massive transfer of private wealth into government control. These are extreme examples, and I am not suggesting the United States is going to nationalize IRAs. But the pattern is relevant. Restrictions on withdrawals are a softer version of the same policy goal, controlling access to retirement capital to ensure it remains in the tax system and is distributed in a way that maximizes government revenue. The United States has its own history of restricting access to savings during fiscal emergencies. In 1933, Executive Order 6102 required citizens to surrender gold bullion and certificates to the Federal Reserve. The official reason was to stabilize the banking system, but the effect was to centralize control of hard assets and enable a devaluation of the dollar. In the 1970s, the government imposed wage and price controls, restricted foreign currency transactions, and considered mandatory investment of pension funds in Treasury securities. These policies were presented as temporary emergency measures, but they all shared a common feature. They restricted individual financial autonomy in the name of systemic stability. The current proposal for retirement withdrawal caps follows the same logic. The language in the Treasury guidance emphasizes preventing abuse, ensuring intergenerational equity, and protecting the long-term sustainability of the retirement system. But the mechanism is a restriction on your ability to access your own savings on your own timeline. And once these restrictions are in place, they tend to expand. The threshold might start at $2 million, but there's nothing preventing future legislation from lowering it to $1,500,000 or applying it to all accounts regardless of balance. The precedent will have been set that the government has the authority to limit withdrawals from tax-deferred accounts, and that authority can be expanded whenever fiscal conditions justify it. So what does this mean for your retirement planning, and what are the repositioning strategies you need to evaluate right now? The first consideration is whether you have accounts that would be subject to the proposed restrictions. If your combined IRA and 401k balances are below $2 million, the current proposal would not apply to you, but that doesn't mean you're unaffected. The broader trend toward restricting withdrawal flexibility and increasing tax collection from retirement accounts affects everyone, and the threshold could be lowered in future legislation. If your account balances are above $2 million, or if you expect them to be by the time you reach required minimum distribution age, you need to model out your projected withdrawals and determine whether the 5% annual cap would create a problem. For some people, the required minimum distribution alone will exceed 5% of the account balance, which means the cap wouldn't be binding. But for others, particularly those who retired early or who have significant cash needs in the early years of retirement, the cap could force them to leave money in the account when they need it elsewhere. The second consideration is the timeline for repositioning. If the rule takes effect in 2027, you have until the end of 2026 to execute any strategies that require distributions from retirement accounts. This includes Roth conversions, which allow you to move money from a traditional IRA to a Roth IRA by paying income tax on the converted amount now. Once the money is in a Roth, it grows tax-free, and qualified withdrawals are tax-free with no required minimum distributions. The advantage of a Roth conversion is that it removes money from the tax-deferred system and eliminates future RMD requirements. The disadvantage is that you have to pay the income tax on the conversion in the year you do it, which can push you into a higher tax bracket. If you're considering a Roth conversion strategy, the next 2 years are critical because once the withdrawal restrictions take effect, your ability to move large amounts out of traditional accounts will be limited. The third consideration is asset location and diversification across account types. If all of your retirement savings are in traditional tax-deferred accounts, you have concentration risk, not just investment risk, but regulatory risk. You're entirely subject to whatever rules Congress and the IRS decide to impose on those accounts. Diversifying across taxable brokerage accounts, Roth accounts, health savings accounts, and even certain types of permanent life insurance can reduce that risk. Taxable accounts don't have contribution limits, required minimum distributions, or withdrawal restrictions. Roth accounts have already been taxed, so future rule changes on tax-deferred accounts don't apply. Health savings accounts, if used correctly, can function as supplemental retirement accounts with triple tax advantages. And cash value life insurance, while not appropriate for everyone, offers tax-deferred growth and tax-free access to cash value through policy loans completely outside the IRS's jurisdiction over retirement accounts. The fourth consideration, and this is where the wealth preservation framework becomes critical, is understanding the difference between tax deferral and tax avoidance. Tax deferral means you're postponing the tax bill, but you're still going to pay it eventually, and the government retains the right to change the terms. Tax avoidance, using legal strategies to minimize or eliminate taxes, gives you more control. Municipal bonds, for example, generate tax-free income at the federal level. Qualified dividends and long-term capital gains are taxed at lower rates than ordinary income, and certain trusts and estate planning structures can reduce or eliminate estate taxes. The point is that overconcentration in tax-deferred accounts creates a structural vulnerability, and the time to address that vulnerability is before the rules change, not after. Now, let's talk about the signals that indicate this policy shift is accelerating. In addition to the Treasury guidance on withdrawal caps, the Congressional Budget Office released a report in September 2024 titled Long-Term Budget Outlook: Fiscal Pressures and Policy Options. Buried in that report is a section on retirement account taxation that discusses several revenue-raising proposals, including lowering the Roth conversion income thresholds, imposing a cap on total retirement account balances, and requiring accelerated distributions from accounts above certain levels. These proposals are presented as options for future legislation, but the fact that they're being modeled and scored means they're being seriously considered. The Department of Labor has also been quietly updating fiduciary standards for retirement plan advisors, with new guidance issued in October 2024 that emphasizes the importance of tax-efficient distribution planning. On the surface, this sounds like consumer protection, but the subtext is that advisors are being directed to help clients maximize tax payments through their distribution strategies, not minimize them. At the same time, the IRS has increased enforcement resources targeting high-net-worth individuals and complex retirement account structures. Audits of IRAs with balances above $5 million have increased by 40% since 2023, and the IRS has specifically focused on self-directed IRAs, backdoor Roth conversions, and inherited account distributions. This is not random. This is a coordinated effort to close loopholes, increase compliance, and maximize revenue from retirement accounts. And it's happening at the same time that Social Security's trust fund is projected to be depleted by 2033, and Medicare's hospital insurance trust fund is projected to be depleted by 2031. The fiscal pressure is real, and retirement accounts represent one of the few large sources of revenue that can be tapped without new legislation. So what do you do right now? The action plan is not complicated, but it requires discipline and a willingness to act before the window closes. First, you need to calculate your projected retirement account balances at age 73 and model out your required minimum distributions. If your balance is going to exceed $2 million, you need to determine whether the 5% withdrawal cap would restrict your access to funds when you need them. If it would, you need to evaluate strategies to reduce the balance before 2027, either through Roth conversions, charitable contributions, or strategic distributions. Second, you need to assess your current tax situation and determine whether accelerating income into 2025 or 2026 makes sense. If you expect tax rates to be higher in the future, either because your income will be higher or because Congress raises rates, paying the tax now through a Roth conversion or a strategic distribution could save you money in the long run. This requires modeling, and it's worth working with a CPA or financial planner who understands the mechanics. Third, you need to diversify your asset location. If 80 or 90% of your net worth is in tax-deferred accounts, you're taking on regulatory risk that you don't need to take. Moving money into Roth accounts, taxable accounts, or other vehicles reduces your exposure to future rule changes. Fourth, you need to understand the estate planning implications. If you're planning to leave retirement accounts to your children, the 10-year rule under the Secure Act already requires them to distribute the entire account within 10 years of your death. If withdrawal caps are in place, that restriction could apply to inherited accounts as well, creating a tax nightmare for your beneficiaries. One strategy to consider is using life insurance to equalize your estate, leaving the retirement accounts to charity through a charitable remainder trust or qualified charitable distribution, and leaving tax-free life insurance proceeds to your heirs. And fifth, you need to stay informed. The regulatory landscape for retirement accounts is changing faster than at any point since the creation of the 401k, and most financial advisors are not tracking these changes closely enough to give you advance warning. You need to be reading Treasury guidance, Congressional Budget Office reports, and IRS notices, not just headlines. The policies that will affect your retirement are being written right now in technical documents that most people will never see, and by the time they're implemented, it will be too late to reposition. Here's the question I want you to answer, and I want you to think about this carefully. Do you currently have a withdrawal strategy for your retirement accounts that accounts for the possibility of new restrictions? Or are you assuming the rules will stay the same? Most people have never thought about this because they've been told that retirement accounts are safe, that the tax benefits are guaranteed, and that they'll have full access to their money when they retire. But the rules have already changed multiple times, and they're changing again right now. The Secure Act changed the rules for inherited accounts. The proposed Treasury guidance changes the rules for high balance accounts. And future legislation could change the rules for everyone. If you're not modeling these scenarios and planning accordingly, you're taking on risk that you don't fully understand. If you found this breakdown valuable, if you understand why this matters and why the timeline is critical, share this with anyone you know who has significant retirement savings and who needs to understand what's coming. The mainstream financial media is not covering this in depth because it's technical, it's boring, and it doesn't generate clicks. But it will have a bigger impact on your retirement security than almost anything else happening in the markets right now. This is not about fear. This is about process, timelines, and understanding the rules before they change. The regulatory framework is already in motion. The comment period has closed. The final rule is expected in 2026, and your window to act is less than 2 years. So take this seriously, model your scenarios, talk to your advisors, and make decisions based on the rules as they're being written, not as you wish they were.